Welcome to a new deep dive. Today we're plunging right into the Q3 2025 quarterly outlook. It's a really comprehensive analysis designed to equip you with that institutional playbook for navigating equities, crypto, and gold markets.
Yeah, and then this isn't just some dry report, right? It's packed with insights you usually get from, say, live streams. It really focuses on the crucial interplay of cross-market correlations, seasonality impacts, and those, subtle signals of institutional portfolio rebalancing.
Exactly. And what's truly pivotal here, I think, is the emphasis on July. It's not just another month rolling by. It's often a crucial transition point for market movements. You tend to see heightened volatility, and it really sets the tone for the whole quarter. Right. So our mission for you today is really to decode these powerful insights. We want to give you a kind of shortcut to understanding how the biggest players are positioning themselves, helping you make sense of, well, everything from how different asset classes interact to capitalizing on those smart money moves. Let's get into it.
Okay, let's kick off with one of the biggest drivers, especially around quarter end, institutional portfolio rebalancing. For those of us looking to stay informed, what exactly does this mean for the market?
Well, this rebalancing act by the big institutions, particularly in the final hour of trading, right at quarter end, it generates significant volatility, a lot of movement. People often call it the smart money hour because it gives us this critical tell, a signal about where institutional risk appetite is actually heading. It's sort of where the big money reveals its hand.
Okay, the smart money hour. So if that's the signal, what did we actually see unfold, at the close of last quarter, specifically on Friday? Yeah, we saw some strong bullish activity in that last trading hour. Very noticeable, especially in tech-heavy indices and those big bellwether stocks like Microsoft, Amazon, Google. It signaled a pretty clear risk-on environment. Microsoft, for instance, printed a very strong bullish candle. The S&P 500 ETF, the SPY, that saw a significant surge too. But honestly, it was Amazon that truly stole the show. It just accelerated like full tilt upward in that final hour. It essentially set the entire trading range for the day right there.
Wow. And what this tells us then is that companies like the Magnificent Seven, those top tech firms, and maybe other AI-driven innovators, they're the prime beneficiaries of this capital flow. Positions them as attractive investments as we head into Q3, right?
Precisely. That's where the money seemed to be rotating into.
Okay. Now, to really grasp these movements, we need to speak the language of charts. Candlesticks. Let's unpack this a bit. How do we actually measure and interpret what's happening underneath?
Right, we measure it by dissecting how these price candles are forming on the chart. Each candlestick tells a kind of story. It has 4 critical price levels: the open, the close, the high, and the low for that period. These levels are really the fundamental building blocks for analyzing price action.
Okay, and what about those wicks, those thin lines sticking out from the main body of the candle? What do they tell us?
The wicks, or price extremes. They're incredibly crucial. Don't ignore them. They show us where the price traveled during the session, but couldn't manage to hold. This can indicate areas of potential manipulation or accumulation zones where buyers or sellers were active. Think of them as sort of battlegrounds, right? Where buyers and sellers fought it out, but one side ultimately won, at least for that specific candle's duration. Understanding these components really helps us predict where price might expand to, or conversely, when a reversal might be likely.
Okay, this is where it gets really interesting for me because the guide talks about flat opens. What are those, and why are they such powerful magnets for future price action?
Right, flat opens. When you spot candles, especially on weekly or monthly charts that have little to no wicks at the open, that's what we're talking about. We call these market inefficiencies. It basically means price moved too cleanly, too quickly, without significant resistance or pullback right from the open. And the critical insight here, the key takeaway, is that markets tend not to leave these inefficiencies unresolved. They have memory. Price will almost always eventually return to those clean opens. They become magnets for future price action. Seriously.
So these aren't just random blips on the chart, they're actual patterns the market leaves behind. How does this kind of analysis play out in real time, say when big news hits?
We'll take recent geopolitical events, like reported tensions between Iran and the U.S. that caused those short-term market drops over a weekend. The analysis here suggests these aren't always just organic market reactions. Sometimes, maybe often, they can be manipulation phases, designed perhaps to trot emotional selling, allowing institutions to quietly accumulate positions for the next bullish expansion. We actually saw this play out in the recovery the prior week. The smart money battle plan seemed to be buy any dip, get positioned long despite the scary headlines. It's really about looking beyond the noise, trying to understand the underlying institutional intent.
Okay, so bringing all this together, What does it imply for the Q3 outlook? Are we still pushing higher, or should we be bracing for a downturn?
The market structure remains fundamentally bullish. The guide suggests a strong target for new all-time highs, probably in July. However, it does anticipate a correction later in the year, maybe September, maybe October. And this is where those flat opens we just discussed could become extremely relevant again. Price might revisit them. They act as targets.
Right. That raises a really important question for any learner trying to navigate these markets, right? If we're at or pushing towards all-time highs, how should you approach entering? Especially when that fear of missing out, FOMO starts kicking in.
Yeah, FOMO is dangerous. The guide strongly cautions against initiating large, long positions right at the peak levels. Why? Well, because the potential for significant forward returns is diminished up there. Your risk-reward ratio just isn't favorable. Instead, it recommends patience. Maybe waiting for a, say, 10% correction to secure far better risk-reward entries for longer-term holds. Now, day trading or short-term swing trades, those are still viable, of course. But building those substantial long-term positions, that demands disciplined risk management. Like, the market doesn't care if you're long or short. Your job is simply to identify and execute the highest probability trades you can find.
Okay. And when a new quarter like Q3 begins, what's a simple sort of strategic approach to positioning yourself for those potential 3-month moves?
Your strategic edge often comes from proactively identifying when that new quarterly candle is forming its bottom wick, that initial dip. Entering long positions during the formation of these wicks, using clear key support levels nearby for your stop-loss placement. That can help you capture those significant 3-month expansions, but with a much more favorable risk profile from the start.
Makes sense. But manually plotting all these levels, especially those critical daily, weekly, monthly opens, it sounds like a lot of work. Is there a more efficient way?
Oh, absolutely. There's a proprietary tool, the Open Indicator. It's called MWDX Opens on TradingView. It automates the identification of all these crucial opening levels across different timeframes, daily, weekly, monthly. It simplifies your analysis hugely.
Okay, an indicator. So how does it actually help a trader in practice? What does it look like?
Well, it basically eliminates the need to manually draw lines for each new session's open, which saves a ton of time. The indicator color codes these levels. For example, it might show monthly opens in yellow, weekly in blue, daily in white, or whatever you set. This provides an immediate, clear visual framework. You can instantly see dynamic support and resistance levels based on those opens. So if the price is currently trading above a monthly open level, that level automatically acts as strong potential support on pullbacks. This visual clarity really enhances your trade precision and, frankly, your confidence in the levels.
Got it. Okay, let's shift gears a bit now and look at how different asset classes are expected to perform, and maybe more importantly, how they influence each other. First up, gold.
Right, gold. Gold typically exhibits what we call risk-off behavior. This generally means it tends to move inversely or opposite to risk-on assets. Take the S&P 500, the NASDAQ, Bitcoin, even certain currency pairs like USD, JPY. So generally speaking, a bearish outlook for gold can often suggest underlying bullishness in these other more growth-oriented assets. It's a common correlation to watch.
Okay, and what's the projection for gold itself in Q3, based on the analysis?
The guide projects further downside for gold. This is partly due to a technical pattern called an inside monthly candle failure. Essentially, the recent month's trading range failed to break out decisively from the previous month's range, which often signals a loss of upward momentum. So the market is expected to test the 3120 support zone. Now, for those looking for potential long opportunities in gold, a high probability entry area is suggested around 3,500, with a stop loss perhaps around 29.71 and an initial target maybe near 3,500. That particular setup offers a very compelling risk-reward ratio, potentially over 5-to-1 for a disciplined trader waiting for that level.
Interesting. Okay, next up, the Nikkei. The guide calls it a global thermometer. Why that specific term?
Yeah, the Nikkei is fascinating. It stands out because unlike the S&P 500 or the NASDAQ, which are, pushing all-time highs or are very close, the Nikkei hasn't quite reached its own peak yet. But the critical insight here is its incredibly strong correlation with the NASDAQ, almost 1-to-1. And even more telling, if you invert the Nikkei chart, flip it upside down, it becomes an almost exact mirror image of the VIX, the volatility index. So a crash in the Nikkei directly aligns with a spike in the VIX, signaling a drop in global risk appetite. Fear goes up. Conversely, a rising Nikkei usually means the VIX is falling, signaling increasing global risk-on sentiment. Confidence is growing. It truly acts like a global thermometer for overall market confidence and risk appetite.
Wow, that's a powerful visual. So how does the Nikkei's movement then affect other global markets more broadly?
Well, a significant drop in the Nikkei can definitely ripple through and impact the entire global financial complex. It's a major index. But on the flip side, if the VIX declines, signaling a rising Nikkei, it points towards a potential surge in global risk on appetite. The current technical setup actually suggests a bullish trend for the Nikkei, with maybe a potential 5% upside from current levels. That would put new all-time highs within reach. Now, if the Nikkei rises 5%, that could translate roughly to a similar 5% upside for other global stock indices. Interestingly, though, the Nasdaq is likely to outperform the Nikkei, perhaps by 7 or 8%. That's mainly due to its heavy weighting in those growth-focused AI and technology sectors. And because the Nikkei market opens about 8 hours ahead of the U.S., its movement can sometimes serve as an early forecast, a leading indicator for a Nasdaq rally later in the day.
That's fascinating, an 8-hour lead. Okay, so if Nasdaq is showing such strength and likely to outperform, what about Amazon specifically? You mentioned it earlier.
Right, Amazon. Its price action typically tracks the Nasdaq index very closely, as you'd expect. But at current levels, the analysis suggests Amazon might offer superior individual stock returns compared to just holding the index, with a potential 8.5% upside to reach its own all-time highs versus maybe Nasdaq's broader 5% potential. The source indicates Amazon presents a pretty compelling case, perhaps for using options like calls to leverage its potential for outperformance within that strong tech sector.
Okay, let's connect this now to Bitcoin. How does crypto, specifically Bitcoin, tie into this whole tech-heavy, risk-on narrative?
Good question. The Nasdaq is often viewed as the alpha asset in this relationship, kind of the big brother guiding Bitcoin, the little brother. Historically, it's very rare for Bitcoin to sustain a major bullish run during a significant Nasdaq downturn. They tend to move together when risk is on. There was actually a period recently where Bitcoin hit its all-time highs, but the Nasdaq hadn't yet, and during that time, some analysis suggests capital rotated out of Bitcoin and into the Nasdaq to capture better perceived returns there. But now that both are sitting relatively close to their all-time highs again, the expectation is they'll likely move more in synchrony. Nasdaq Q leading, Bitcoin following.
All right. And given that relationship, what's the Q3 forecast look like for Bitcoin itself?
Well, Bitcoin's performance seems tightly linked to the Nasdaq's ability to sustain these high levels or push higher. The analysis points towards a potential pullback, maybe to the 97,000 level for Bitcoin. That could offer an attractive long entry point, with a potential stop loss maybe around 93,000 and a longer-term target perhaps near 120,000. This outlook reflects a view that Bitcoin is consolidating within a large bullish flag pattern that's been forming over roughly the past 6 months.
Okay. And what about Ethereum, ETH, the second biggest crypto?
Yeah, Ethereum. For ETH, a quarterly candle closing above key prior support resistance levels does indicate bullish potential. Longer-term picture looks constructive. However, this bullishness is somewhat tempered in the shorter term by a technical pattern known as a bearish weekly short block formation, basically signs of recent selling pressure on the weekly chart. So a dip, perhaps towards the 1934 level, could provide a solid long setup opportunity. This might offer a favorable risk-reward ratio, targeting maybe 3,200, but it's kind of contingent on price first testing that broader 1750 to 2142 support zone. The bullish idea would be invalidated if the price decisively falls below that 1751 level. Gotcha. Finally, let's touch on the Dow Jones, the DJIA. How does it compare to these other indices and what's its outlook?
Right, the Dow. The Dow Jones Industrial Average has definitely lagged behind indices like the Nasdaq or even the S&P 500 recently. But the guide sees this as a prime catch-up opportunity. The upward movement of some Dow heavyweights like JP Morgan, which is already hitting its own all-time highs, is seen as a signal that the broader Dow index will likely follow suit. This projects potentially a 2.6% rise, maybe 1,100 points or so, to take the Dow to new peaks, and potentially quite soon, maybe even as early as next week, according to the source. For a specific setup, a pullback towards 43,084 might offer a highly favorable risk-reward long entry. And interestingly, this potential upward move for the Dow is somewhat foreshadowed by the Canadian TSX index. The TSX is already trading above its all-time highs, which suggests that sideline capital, globally, might be actively looking to rush back into U.S. equities, including the Dow components.
Okay, great context on the indices and major assets. Now, beyond these broader markets, the source also highlights some specific company setups that could be compelling for Q3. Let's look at Apple and Tesla first.
Sure. For Apple, the analysis points to something quite rare, a double inside monthly candle. This is a pattern where 2 consecutive months trade entirely within the range of the month before them. It signals consolidation, coiling energy, often preceding an imminent, powerful breakout. This potential breakout is kind of enhanced by July's generally favorable seasonality for Apple and also its upcoming earnings report on July 23, 2025. Now, given Apple's huge 10.5% weight in the Nasdaq queue and the ongoing narrative around AI-driven consumer demand, a 30% rally from current levels to new all-time highs is seen as definitely feasible. Apple rarely stays stagnant for this long.
Right, a coiled spring perhaps, and Tesla, which has certainly seen its share of volatility recently.
Tesla, yes. It's showing what's termed an inside quarterly candle failure. Now, despite the word failure, this pattern actually indicates strong upside potential, especially after retesting the 273 support level. So a long entry considered around that 273 level, maybe with a stop place just below it, and targeting eventual all-time highs. That yields a very strong potential risk-reward ratio, over 5 to 1. And this bullish outlook is strongly supported by Tesla's ongoing transformation and its clear leadership position in AI-driven technologies beyond just cars.
Okay. What about maybe more emerging opportunities, perhaps in less traditional sectors that the guide mentions?
Yeah, the guide specifically points to eVTOL companies. Think Archer Aviation and Joby Aviation. These are pioneers in electric vertical takeoff and landing technology, essentially flying taxis, air taxis. Now, despite currently lacking significant cash flow or fully operational products yet, they are viewed as compelling long-term investment opportunities, high risk, high reward potential. Their first air taxi prototypes are actually scheduled to debut in November 2025 over in Dubai. Post-launch, assuming it goes well, these stocks could see significant rallies, potentially 100%, maybe even 150% according to the analysis. And Archer's strategic partnership with Anduril, a major defense tech company, also helps bolster its credibility and long-term potential in this emerging space.
Very interesting looking ahead there. So wrapping this up, this deep dive into the Q3 Elite Strategy Guide has really highlighted the dynamic nature of market movements, hasn't it? Revealing those institutional playbooks at work. We've definitely seen how strategic portfolio rebalancing at quarter end creates that significant volatility, particularly be benefiting tech-heavy indices and growth stocks.
Exactly. And we've underscored the critical role of understanding the language of charts, decoding those wicks, the flat opens, the quarterly candle formations to better anticipate market reversals and expansions, all aided potentially by tools like that open indicator to streamline the process.
Yeah, and from gold's risk-off behavior acting as a kind of barometer to the Nikkei as that global thermometer, and that really fascinating alpha-beta dynamic between the Nasdaq Q and Bitcoin. Understanding these cross-market correlations seems absolutely key to optimizing your capital allocation, doesn't it? We even got into specific setups for giants like Apple and Tesla and that exciting potential in the emerging eVTOL sector.
Absolutely. And ultimately, it bears repeating. The market doesn't care if you're long or short. It just moves. Your job as a learner, as an analyst, is really to continuously hone your skills to identify the highest probability trade setups to figure out where that next opportunity might lie.
So the question for you, as you continue to navigate the markets in Q3 is, what will you look for in the price action, in the market structure? Will you be actively seeking those quarterly candle bottom wicks to perhaps enter positions early? Or will you maybe strategically wait for potential 10% correction before taking on significant new long positions, especially near those all-time highs? Keep honing that disciplined execution and patience. Understand that real clarity in the markets, even in things like currency trades like USD/JPY, often comes with further price action and that careful observation of institutional intent.